Start counting to 10.
Good afternoon and welcome to today's installment of Saul Sessions. I am Jonathan Havens, one of the co-chairs of the cannabis law practice here at Saul Ewing. I'm joined today by my friend, partner, and fellow cannabis group co-chair Adam Fain. We're going to be talking to you today about cannabis M&A, pain points, and opportunities. Before we launch into our discussion about M&A, want to remind you that our next Saul session and our final in the series is on July 16th. And that will be on litigation risk in and around the cannabis space. So with that, Adam, welcome to Saul Sessions. Glad to be in conversation with you today. And I thought we could just jump right in. If you give our attendees a sense of what you've been seeing in the deal market for the past 6 months or so, and also if you could address how the announcement around the potential rescheduling of marijuana federally has impacted that.
Yeah, thank you, Jonathan, and welcome everybody, and thank you for attending today. The deal side of the business has been picking up a little bit. It was a slow start to the year. I think Schedule 3 has has caused the markets a little bit more activity. But I'll tell you, historically, the types of deals have changed. So historically, I'd say we, did deals all across the landscape, whether they were single licenses, buying paper licenses, buying single operations in one state or two states. And we also were doing large 9-figure acquisitions, large mergers, both public and private. The larger stuff we have not really seen at all since the beginning of the year. We are seeing a lot of what I'll call ones and twos. So we're seeing a lot of paper licenses exchanging hands in the various states. We're seeing a lot of operating, single store or maybe two store, operating licenses, or not licenses, operations changing place. Sometimes they're cultivation. We're doing a lot more retail right now, Jonathan, less cultivation on the transaction side. I think people are very interested in the retail sector of this business right now. It might have to do with, sort of barriers to entry as well around the cultivation side. Although in a state like Illinois, for example, we are seeing some craft grow transactional work, but it doesn't compare to the volume of the retail licenses that we're seeing. One thing that has so that's kind of what we've been seeing recently. We've also been seeing a lot of real estate activity. We've seen a lot of the existing real estate investors. Some of them are private public REITs. Some are just individual high net worths. We see a lot of real estate activity, a lot of sale leasebacks going on. I think people are getting pretty comfortable with that market, and it has picked up a bit since the announcement of Schedule 3. It hasn't been a tremendous pickup in any of these markets, but you're seeing a little bit more of the transactions around the fringes. We hoped it would get more. At first, the capital markets, the stocks, went up quite a bit, and then they sort of settled back down to where they were before the announcement. And I think in some cases they're lower, but wasn't quite the uptick we hoped for. But maybe when, or I should say, if and when the Schedule 3 becomes final, that people will come off the sidelines and there'll be even more transactional work.
Yeah, well said. And let's stick with Schedule 3 for a second, and maybe you've kind of sufficiently addressed this, or we've handicapped it as much as we can, but let's drill down a little bit. Let's say Schedule 3 happens. I know we've talked on previous Saul sessions around timing and what that could all look like, but putting that aside, assuming Schedule 3 happens, what does that do to the M&A landscape? What does that do to capital? Let's play that out a little bit. Let's tease it out a little bit.
Yeah, so not going to get into a deep discussion of Schedule 3, but the biggest, what I believe the biggest impacts are going to be for Schedule 3 is the removal of Section 280E of the tax code. And um, it will also probably get some people more comfortable around this space. And so what does that mean? So around the 280E part, I think it becomes a more the, the existing operators become more attractive, right? And they also are attracted to other deals because the financials improve. 280E is a huge burden on the financials of whether you have one store, whether you're a multi-state operator. So if Schedule 3 happens, the underwriting of these assets gets better and gets more attractive to be a target. So I anticipate that if it happens, we will see a lot more deal flow because these companies, which many of them are not profitable despite having pretty solid businesses, but those businesses may become profitable overnight. It'll also bring people in off the market, I mean, off the sidelines. So, you know, one of the challenges in this market is we see the same, for the most part, the same cast of characters sort of doing all the deal work in this market, putting the capital to work, raising the capital. A lot of times the same, you know, few investment bankers out there. And I think if Schedule 3 passes, I think you're going to see a lot more um, players in the industry. You're going to see more banks coming in. You're going to see more capital, different types of capital. It may or may not be institutional capital. I mean, that's sort of, people just don't know that yet. But it might be more family offices. It might be more high net worths. It might be more companies that are investing in the space. It's been the same cast of characters for so long that it'll be. I think it's going to energize people coming off the sidelines, and people will get more innovative and just. I think you'll see an innovation of the types of investors, the types of money, the innovation of products, and so forth. I think what Schedule 3, isn't going to do, and maybe one of the reasons that there's an issue, that hasn't been as a catalyst as we had hoped, is there is a existential threat to some of the state licensed operators with D9 and D8 production, right? So, cannabis derived from the hemp plant or synthetic cannabis. Now, many states and the federal government, they're all talking and discussing regulations around D8, D9. Some states have passed their own laws. Ron DeSantis, I believe, just threatened to veto the regulatory framework for D8 or D9. I'm sure you have more clarity than me, but so while Schedule 3 is great for the industry, there are still, certain threats out there to the existing stakeholders. I think banks will come in, right? So I think banks will. I'm not sure if you're going to have the money center banks or not, but I think there will be a lot more banks that come into the market if Schedule 3 happens. That's going to add liquidity to the market, add capital to the market. People are going, companies are going to be able to find, financing opportunities. Companies that have high debt right now, high interest debt right now, may have the opportunity to refinance that debt at lower rates, which will drive profitability. So, there's a lot of really good things around Schedule 3. It's not going to solve all the problems, but it's certainly going to help.
Yeah, I agree. And, it's interesting. We're certainly hearing from what I'll call traditional state marijuana market companies, whether that's single state or multi-state operators, both public and private, who are asking continued questions around the intoxicating cannabinoids and hedging, right? As some have referred to it, as being involved in both the state regulated marijuana market and the intoxicating cannabinoid market. Conversation for a different day. There's risk reward to hedging, so to speak. But you mentioned Florida, right? Governor DeSantis vetoing that hemp framework. There's been some reporting around, was that with an eye towards trying to undercut, strengthen competition against the state regulated marijuana market to defeat take some of the wind out of the sails of the ballot initiative this fall. Again, conversation for a different day, but you kind of see how these policy measures are feeding into the M&A framework, and how policy is and regulatory framework is the jumping off point for a lot of what we're doing. So before I transition into regulatory and some pain points around M&A, I just did want to mention for our attendees, if you do have questions, please drop a question in the Q&A box, and we'll certainly get to it. So on pain points, Adam, to me, regulatory can be one of the bigger pain points in the cannabis space. We talked about capital and how cash is very expensive, right? But I hope you would agree with me that regulatory can be a pain point, or at least a sticking point. But whether it's regulatory, whether it's access to capital, what are you seeing as the biggest pain points, cannabis industry specific pain points from an M&A perspective? And if you want to tie that to what gets better under Schedule 3, what doesn't, and what doesn't change, that's great too.
Yeah, so if I think about the pain points in a cannabis M&A deal, number one is regulatory, as you properly identified. It's every state has a different regulatory framework, and dealing with the regulators in every state is different. And so there are a lot to start with in the cannabis deal. Because of the regulators, everything takes longer. A lot of times a closing almost all the time, every time I would say, your closing contingencies are tied to the regulatory approval. And it's a different regulatory approval process in every single state. And if you can think about, from a single state operator, from just a single state transaction, I should say, you're dealing with one regulator, right? So, you sign the documents, everyone submits their whatever they have to submit for regulatory approval. You almost never should expect that your first submission is going to be your last submission. They're always going to have questions. They're always going to ask you for more information, which continues to slow down the process. So it's the regulatory considerations are definitely the number one pain point. And think about when you have two or more states and the deal is contingent on, you have a closing, and so you're only, the buyer only wants to buy, let's say, all three states. They don't want to buy one. They're in the deal. They, to buy the whole, the whole pie. Well, you could get regulatory approvals at different times, and so you got to navigate that and balance that, right? So let's say you get regulatory approval over here. Okay, great. You check a box. You still can't close to get regulatory approval over here, but sometimes you might want to be integrating over here while you're waiting over here. So there's a lot of moving pieces, but regulatory is, I would say, the number one pain point with M&A. Now, I will tell you, and I think, Jonathan, you would agree, over time, the regulators have gotten better. It could take us years to get a deal approved. At least over a year, 1 to 2 years to get a deal approved by the regulators. Over time, though, it has gotten much better, I would say, just about across the country. Regulators are becoming more, I feel like they started where they were almost our adversaries in this business. And they learned, and we learned, the private side learned that we're all partners in this. So a lot of the regulators, I feel, are starting to treat the industry like a partnership as opposed to, a cat and mouse game. So I think that's been really helpful, and it's been really helpful to the industry, and things move faster, but they're still not fast. So you have to manage that. Some other pain points. We talked about capital, right? So, historically, there was a lot of stock deals, a lot of people giving, acquiring assets or cannabis operations for their public or private stock. We see a lot less of that these days. The sellers are, more demanding. They want cash. So that becomes a little bit of a pain point because not most, but many cannabis companies don't want to give up cash because cash is really expensive. It's hard to obtain. It's hard to generate. It's just expensive everything about cash in the space is very expensive. So cannabis, the buyer typically wants to pay with as much stock and equity as possible. The sellers want cash. So there's sometimes a disconnect there. Similarly, a lot of the buyers out there, their balance sheets aren't the prettiest thing in the world. They have a lot of debt. They have a high interest rate debt. Some of that may get solved with Schedule 3, as we talked about. But the pain point in an M&A deal is where you have a seller's note, where the buyer may not be paying all the cash up front, but may say, okay, I'm going to pay you $5 million today in cash and a $5 million note. The sellers want to guarantee that note's going to get paid. So sellers these days are demanding more guarantees of that debt from directly from the principals or from assets that have available equity in them. So that is becoming a pain point in these deals because the sellers are skeptical sometimes that the buyers are going to be able to perform in the future in satisfying that liability. Tied to regulatory is the length. The length of these deals it can be very, very long. It's largely driven by the regulatory framework, but it's just something to point out that you may sign a deal today, but by the time you close, it might be sometime in 2025. By the time you get through all the regulatory process, and a lot of things change, right? So 6 months is dog years, right? In this industry, and so a lot of things can change in 6 months where the parties get, the market changes, regulatory stuff changes, capital markets change, and one party may, get skittish, as time goes by. So length is not a friend to the industry. But I would say, and the last thing I would say is due diligence. So a lot of times when you're marrying two parties by way of a merger or an acquisition, the due diligence can be a little bit of a pain point. A lot of these companies grew quickly, and as they grew so quickly, some of their corporate maintenance and their corporate house, what I'll call it, doesn't exactly have every I dotted and every T crossed. Not for any bad reason, it just grows so quickly, and there's a level of priorities. Making sure your minutes are up to date isn't exactly everyone's priority. But when a buyer comes in and they're going to they want every I dotted and every T crossed. So there's a lot of catch up from a seller's perspective to, clean up their corporate house, which it all gets done. It's not a big issue, but, usually I should say it's not a big issue, but, sometimes when you're doing the diligence, the sellers aren't even aware of some of the statements they're making may not exactly be accurate, and not for a nefarious reason, but just because time has elapsed and no one's been paying attention to it, and buyers are frequently pointing out in due diligence, you got to take care of this, you got to take care of that, you got to do this, all this dotting I's and crossing T's before they're comfortable closing. So those are what I would say are the pain points in a cannabis M&A deal.
Yeah, it's interesting. People always say to us, how do we get ready to be acquired or to enter into a deal? And the first thing that I'll say, I'm selfish as a regulatory lawyer, and this isn't sexy, it's like, make sure your licenses are well organized and we know all your expiration dates and you have up-to-date copies of your licenses. Seems, basic and common knowledge, but, we've both seen messy data rooms, to put it mildly, which just drives up legal, right? When you have to request documents multiple times. So again, not the point of this conversation, but it is a challenge sometimes in these discussions. Back to regulatory, I think one of the things, your point about, I kind of laughed when you talked about stock versus cash. 17, 18, 19 deals were 75% plus stock focused. Sometimes we didn't even see any cash exchanging hands. Right now, it's flipped on its head. It's almost all cash, if not 100%. which again, to your point, people don't have a lot of cash, but these stock, the valuations, I think people are skittish. So people should expect that cash will be asked for primarily rather than stock primarily, unlike how it used to be. The only last thing I would say is, the regulatory framework driving the fundamentals of the transaction. Look, we always are structuring that accomplishes the goals for our clients, but sometimes there's very stringent frameworks, and I'm thinking craft grow or social equity licenses or certain kinds of licenses, and you can try really hard to craft around what your clients want, but sometimes if you don't craft the deal in a way a regulator sees fit, they're just not going to approve it and can extend indefinitely. So, we talked a little bit about capital markets and stock, but wonder if we could switch the conversation a bit to uplisting, right? I think one of the things that people had been excited about initially around rescheduling is the potential of uplisting. Now we've heard responses, so to speak, back channel responses from the exchanges, but wonder if you could talk a little bit about uplisting and Schedule 3.
Yeah, so, uplisting is everyone's hope that Schedule 3 is going to solve for that. What you and I have been told, and what we have a pretty good authority that Schedule 3 alone isn't going to move the big markets to allow uplisting. And that doesn't mean that it's not a component of it, but you might need, and they've been non-committal to exactly what it would take. But if I had to speculate, I would say that maybe a new Cole memo, like a Garland memo, giving the financial institutions like the stock exchange comfort that might do it with Schedule 3. Maybe some form of safe banking language might also help with Schedule 3. But the markets are conservative places. While these companies are great companies, and there's a lot of public companies out there, and there's a lot of value to these companies, a lot of the markets are just be conservative, and they don't want to risk what they have to become afoul of any laws that they don't necessarily need. But we've been told Schedule 3 is just not going to do it. It doesn't mean the markets can't change their minds tomorrow, or somebody on this call or somebody in the industry can't convince them otherwise. But up until recently, we've heard that Schedule 3 is just simply not enough. But we'll have to see what comes along with Schedule 3. I assume there's going to have to be some sort of guidance out there. People talk about a new FinCEN memo and a Garland memo and so forth, but I think we got to get through Schedule 3 first. But I don't think day one of Schedule 3 you're going to see a lot of uplisting, unfortunately.
Right. So obviously the lure of public markets, of capital markets, is access to capital, right? So given that access to capital has been tight, and that we're not even in Schedule 3 territory yet, how are people accessing capital? How are they raising money?
It's a good question. As you know, and what is public, we have been involved in several public capital market transactions, recently. But there it's not like it was, right? So there is some liquidity out there. There is some available capital out there, and we're working on some of those deals. But the problem is, there's a couple of problems. One is there's not that much capital out there, right? It's still, again, largely the same investors out there. So, I mean, of course, there's some new ones that come on every day, but, from a, for the scale that's needed or wanted, there's just not enough capital out there. But also a similar problem is especially on the public side of the house, the public operators don't necessarily want to raise capital in this market. Their stocks are all, down dramatically. They all believe that the value of their companies are higher than what the public markets are showing. And so they're not that anxious to run out to the markets and raise capital. So even the raises that you've seen in the last, 6, 9 months, have been on the smaller side. And it's, maybe it's somewhat of a function of the money that's available out there. And there's no doubt that's probably part of it. But the other part of it is these companies just don't want to raise a lot of capital at these prices because they don't want dilution for their shareholders. So it's a chicken and egg thing. But, so, I mean, that's on the public side. On the private side, there's some debt out there, right? So there are debt opportunities out there. It's still very expensive. I think Schedule 3 will change that. I don't think the debt won't be as aggressive, won't be as punitive, and so forth. So I think people will take advantage of that. On the private side of the market, we've seen pretty good activity on the capital markets. There's a lot of private activity out there, private buyers buying and selling assets out there. And some of these are big deals. I mean, it's private; they're not announced, but some of these are big deals. And so I think there's, in a weird way, just more private money out there than public, and it's probably a function of the stock prices, right? The private companies, they're private. They're not subject to the whims of the market. Obviously, the market has some sort of impact on their valuation, but they seem to be doing better in the capital space, is what I would say.
Yeah, appreciate that. Totally agreed. No surprise, but we'll hang on for another minute or so here. Again, if you have questions, please drop them in the Q&A. I'll just remind folks again that July 16th is the next installment of Saul Sessions and the last one in the series. We certainly hope you've enjoyed it and appreciate any feedback you might have. But given that we don't have any questions in the queue, Adam, I just want to say thank you for your time. Always great to chat with you about these issues. And again, appreciate all of you attending today, and would encourage you to attend next month's session on July 16th. Thanks so much, and have a great afternoon.
Thank you, everybody.